Good morning, everybody, and welcome to Thrivability PPP. You've got it. Now what? My name is Trisha Badi. I'm doing a brief introduction this morning. I just wanted to kind of say welcome and how excited we are to have you guys here. We've got a lot of people participating today, and we know this has been a very hot topic and that is something that's been needed. We've been using a lot of our survey results that you guys have been participating in to really program for what is needed. And Thrivability is really about that resilience training that we're trying to be able to provide, but we're really using your input to kind of drive this program and understand what the needs are. So I'm going to pass this over to Nirupa, but I just wanted to really thank you guys for coming. It's great to see all your faces. I know we're probably all over Zoom calls, but we really appreciate an 8:30 time. And if you haven't already, please make sure you just mute your phones if you're not speaking, just so that we can not have any background noise. But anyways, thank you. It's great to see everybody, and I'm going to pass it off to Nirupa.
Thank you, Trisha. Hi, everyone. I'm Nirupa Netram, the Director of Foundation and Legal Operations here at Collaboratory. Today's program features a panel of experts who will review compliance and other important rules associated with the Paycheck Protection Program, also known as PPP. You're going to hear about PPP through the lender's perspective, from an accountant's perspective, how forgiveness can be reduced if you lose employees or sufficiently decrease their wages, and the audit and appeal process. Today's panelists are Greg Blurton, Vice President, Senior Commercial Loan Officer at Edison National Bank, Erica Harp, CPA at Hughes Snell and Company, PA, and Sarah Qureshi and Michael Leonard, attorneys at law at Henderson, Franklin, Starnes, and Holt. Please note that the information provided in today's webinar is fluid and subject to change. We are recording this webinar, and we will share the recording and slides with each of you. We're also pleased to have with us today in this virtual space our team member, Kim Williams, Manager of Networks, Systems, and Physical Plants. Kim is assisting us in the virtual space today. We ask that all participants please use the chat box to ask your questions. We will respond to each of those questions after our last speaker. Here's our first speaker, Greg Blurton. We may be having some technical difficulties with Greg's audio, so please be patient with us.
Can you hear me all right?
We can hear you, Greg. Thank you. And we just lost you again, Greg.
Can you hear me all right?
We can hear you again.
Sorry. Oh my goodness gracious. So technical difficulties. My apologies for that. We've had some technicalities with this program as we've gone forward, so maybe that's apropos for the subject. Happy to be here, and thank you very much to the Community Foundation, to the Collaboratory, Kim, Trisha, and Nirupa for everything that they've done to help us get to today. And to my fellow panelists, I'm honored to be joining you on this presentation. So the PPP, you've got it, and now what? You know, it's maybe easiest to say take a couple aspirin, call us in the morning, but it's not that easy, and none of us are doctors, at least not yet. And my portion of the presentation, which we'll step through quickly, because a lot of us have been on these Zoom meetings, we've got a lot of content that is very subject to change, but I know a lot of you really have a ton of questions, so I know we want to get to those because there's been so many changes just in the past week to this program. So before I bring you back behind the curtain a little bit, I do want to reiterate what Nirupa had said. The content is very fluid. It is subject to change. And on that note, I have a quick video to share that I think sums up the program in a nutshell. So, and I hope it doesn't buffer too much. Kim? Oh. There we go.
Some people like to climb mountains. I like to build planes in the air.
I grew up wanting to be on a wing, wanting to be up this high.
Sometimes the temperature up at altitude will reach 60 below. It's brisk, it's refreshing.
You never know what you're going to come across up here. Canadian geese, mallards,
Owls.
These people back here, that's why I come to work. That's why I build airplanes in the sky.
We're not just building a plane here. We're building a dream.
I love this job.
I do a lot of things up here. When I look over there and I see the little kid, and I look in his
So I like to build airplanes in the air, and that really, I haven't come across an analogy that really sums up the program because we truly have, as we've been a part of this program as bankers, as lenders, and everybody, you as the borrowers that have this program, it has been building airplanes in the air. It's been as we go. So, you know, where we've been, and I won't spend too much time here because everything that's on here really is in the past. When this program rolled out on April 3rd, which seems like years ago, you know, we had 2 rounds of funding. The most important piece here is actually through June 6th, there has been just over $511 billion of funded PPP loans to date. And there is about $130 billion left, and that is through June 30th of this month, so at the end of this month. You know, what's most important on this slide is that the forgiveness application was released in mid-May, and since that time, there have been wholesale changes made through the passing of the Paycheck Protection Flexibility Act of 2020. The House passed that, then the Senate, and then the President signed it just before this past weekend. So it represents wholesale changes where I'll spend a little bit more of our time on that. So, you know, that's where we've been and where are we going? Next slide, Kim. You know, I use my friend Ted here from Bill and Ted's Excellent Venture Here guest is as good as mine. And it's a little joke, but I use it as an example to, again, reiterate and make the point that there has been so much information, so much chatter, so much conjecture, opinions as to what has been released recently that, you know, we're trying to keep up just as much as you are. What we do have a benefit of is we do have direct access to the SBA. We have good colleagues over in the SBA in our district office that we ask many questions to, and a lot of the frequently asked questions that you see on the Treasury's website have come from you as the borrowers and us as the lenders to the SBA. So this is a loan program like never before. It has, and it's continually changing. So, you know, even though, you know, we are right in the middle of it and are your resource, you know, the expertise of this program is still evolving. Next slide, please. So we can expect more changes, and I won't focus too much on the current side on the left of this slide that you have here because everything that you see there has changed. And the proposed is now into law, but we are still expecting forthcoming guidance from the SBA and the Treasury in the forms of what we call their interim final rules, or IFRs. So what is coming and the details of that, how this gets rolled out, is, you know, we've had that in the past, the 75-25 rule, where you've had to use your payroll, your proceeds from your Paycheck Protection Program on 75% of the payroll, and then the 25% towards eligible non-payroll expenses, such as business mortgage interest, utility expense, Now that's changing to 60-40, so 60% on payroll. And there were some caveats to that have since been backed off. We'll talk a little bit more about that, and I'm sure you have questions about that. It was an 8-week covered period, and Erica has a lot more detail to this about what are the non-covered and covered payroll expenses. The loan payments being deferred until forgiveness is determined by the SBA. So when you submit your forgiveness application, which a lot of lenders and bankers, including us, are telling our borrowers just to hold on to their application because the application is being modified to apply for forgiveness. And that determination by the SBA, once you do submit that application to us, your lender has up to 60 days to review, and then the SBA has 90 days. So you were going to start paying principal and interest after 6 months. Now that is being deferred until the SBA makes their determination on forgiveness. The loan maturity up to 5 years. I know Michael has some content to this of how that's changing. And what we are asking for as a banking community, as a lending community, is a more streamlined application and process, because I'm sure a lot of you have seen the 11-page forgiveness application that, if you read the fine print, requires a calculus degree. There is no fine print. You don't have to have a calculus degree, but there is tremendous calculations involved and tremendous information and documentation that you have to have. So, but even so, that application is being modified. So lots of changes. Next slide, Kim. So in the meantime, we have panelists, Erica, Sarah, and Michael, who are going to speak to a lot more of these in detail. But even with all these changes here, just quickly, some of the things that are consistent and remaining the same. Borrowers still have significant responsibilities for the forgiveness process. And as do the lenders as well, and some considerations. Review and reference the interim final rules that are accessible via the Treasury's website. There are 16 of them currently. The last two, I believe, numbers 14 and 15, speak specifically to the loan forgiveness and then the borrower and lender's responsibility for forgiveness. Those are being updated. Those are being modified. And if the SBA and Treasury hold true to how they've been releasing these with massive changes coming, they usually release them in the wee hours of the late night or wee hours of the morning on a Friday or a Saturday morning. So we're hopeful that the new rules regarding these big changes will be coming by the end of the week, hopefully sooner. But they are what we go to. That is where our guidance is. That's where our official rules are. We use those frequently. Understanding your non-payroll expenses, Eric is going to speak to those in more detail. Understanding those safe harbors, Sarah has some slides on this. What happens if you reduced salaries for your employees or reduced employees. There's no such thing as too much documentation, and Michael has some information to this. There's a 6-year retention rule, so keeping all of your documentation for up to 6 years. And then again, lenders have 60 days to perform that good faith review, and then the SBA with 90 days. So, that's really quick, and I apologize for the technical difficulties first off, but I at this time will turn this over to my colleague, Erica.
All right. Well, thanks, Greg. Yes, as Greg mentioned, we are building a plane in the sky here. There's a lot of changes that have already happened since the program has been rolled out, and there's a lot of changes to come. Kim, next slide. So, you all may have checked out the application for forgiveness, the form 3508. That form is actually going to be changing. We hope we'll see something here, again, as Greg mentioned, by the end of the week to see what the new form is going to look like. But what I'm going to concentrate here a few minutes on is, what are your covered costs? What are the payroll, non-payroll costs? What periods? What are your covered periods that we're talking about? Next slide. So, I won't spend, again, time much on the current provisions, because those have already changed under the PPP Flexibility Act that was just signed last Friday. We have, under the proposed use provisions, the payroll expenditure requirement dropping to 60%. So it's a 60-40 split between payroll related costs and non-payroll costs. And more importantly, the change in the covered period has been extended. You have an option to extend it from the 8-week period to the 24-week period, which ends on December 31st. So the earlier those dates. The CLIP provision, as Greg alluded to, that has been, clarifications already come out. There was a joint letter that was statement made by the SBA and the Treasury. And basically, it's interesting, and even in the wording of the letter, it says, if a borrower uses less than 60% of the loan amount for payroll costs during the forgiveness covered period, the borrower will continue to be eligible for partial loan forgiveness, subject to at least 60% of the loan forgiveness amount being used for payroll costs. So even in the joint statement, they made that very unclear. However, the intent there is really that we are not in a cliff provision. If you don't use the 60% for payroll, you would get a partial forgiveness. What that looks like, how that's going to be applied, we're going to be waiting on those interim final rules to find out. Next slide, please. All right, so we're going to talk about the covered costs, and we're looking at payroll. Obviously, this is your 60% eligible for forgiveness. And what I want to stress here is you're really starting with your gross pay. So that's going to include your salaries, your wages, commissions, housing stipends, bonuses, and there is a 100,000 annual limit. Now the annual limit is based on the 24 weeks, which puts you at 46,154 per employee. And under the 8 weeks, that was 15,385. So you can see how much more that opens up to allow for us to meet that 100% forgiveness. It also includes the health insurance premiums, retirement plan benefits. What it does not include, and some of the earlier payroll third-party providers and things we're putting out in the application process, that it included the employer portion of payroll taxes that related to self-employed or Social Security and Medicare. So for the FICA, they were including that in the eligible costs. That is not retirement benefits. So that was the definition they were trying to use. They're getting a little creative. So no employer portion of payroll taxes are included in the eligible payroll costs. And state and local taxes, that's going to be your SUTA and local state taxes that you're able to include there. So those are includable, but the federal and the employer portion of payroll taxes are not. Okay, next slide, please. Now, timing. So, you see the covered costs. What's the timing of payment for the payroll costs? Now we've moved from this 8 to 24 week period. Now, as far as we know, the election is going to be to use the 8 week period. The 24 is going to become the default. Now, with respect to payroll costs, there's a couple of ways that you can approach that. And one of the things to know off the top, and this applies to all costs, it's paid or incurred. So what we kind of are saying here is that it's really going to be cash on the front end of the loan or the covered period, and on the back end of the covered period, you're looking at an accrual. So what I mean by that is if you've got some payroll for periods that existed before the covered period that were unpaid, if you pay them within the covered period, that would be includable. If you have, at the end of the period, if you have some payroll that had been incurred but has not hit the normal payroll cycle yet, that can be included in that period. So you get to accrue those costs. Again, we're not splitting hairs so much about this anymore since we were able to move from that 8 to 20 week period. But for those who elect the 8 week period, this becomes pretty important. And then we look at, on terms of payroll costs, there's an opportunity to take an alternative payroll covered period election. What that opportunity is really for only people who are on a biweekly or more frequently payroll schedule. And it's just allowing you to mirror your cover period with your normal pay cycle. Important thing here is to make sure that it's consistently applied. So basically it's saying your cover period rather than the date of the funding, which is generally when that cover period starts, the 8-week, 24-week clock starts, it would be moved to the first pay period that occurs after that date to allow you to keep consistent with your pay cycle. If you have some people that are on a monthly pay cycle and you have some people that are on a biweekly pay cycle, then you're going to need to be consistently applying it to those particular groups. The next slide, please. So we talked about the payroll costs, the cover period. There's some work around there with the timing of those costs. The non-payroll costs. Now this was a highly intensive area here with respect to what's covered, what's not covered. What is utility? Suddenly we're trying to define utilities, and unfortunately that's been the real muddy waters here because we haven't received any additional guidance since the initial rollout on what's qualifying for some of these. This becomes, again, less important if you're using that 24-week period. So, you know, when in doubt about whether or not these costs are going to be includable, it would not make sense to use them if it could cause any question. And plus, as we start to see some of these people who elect the 8-week period go through the process, we'll have probably some more guidance and better understanding of what's going to be accepted in these rounds. But for the most part, it's pretty straightforward. Besides the utilities, we're looking at interest payments on mortgage for real or personal property. Now that does include a car loan, a equipment loan, those type of interest payments. Rent payments under lease agreement, that's very important, the fact that it needs to be under a lease agreement. And then utility payments for electricity, gas, water, transportation, telephone, and internet. The real questions have arisen in the area of transportation. Does that include mileage? Does that include vehicle costs? Or is it just the transportation costs related to getting electricity and gas and water to the locations? Again, very little guidance here, and we may not see very much considering we have an expansion of the other types of costs that can be included, or the period that can be included. Important too to make sure that you have a lease agreement, service contract, mortgage in place as of February 15th for these type of costs. So it cannot be something new that you've entered into since February 15th. It needs to have existed at that point in time in order to qualify. And the next slide. And with the non-payroll costs, there's less flexibility here. The cover period is starting with the loan funding. There's no elections. There's no prepayment of expenses permitted, but remember we talked about cash at the beginning and accrual at the end. So it's either needs to be paid or incurred during the cover period and paid within the next billing cycle if it's going to be accrued at the end. So for instance, if your period ends on, say, the 26th of the month and you have a rent payment due on the 1st, if you pay it on the 26th, then you'd be able to include that whole rent payment. If you pay it on the 1st, then you get to include the 26 days that apply to the covered period. So there is some leeway there. And then obviously at the beginning, because we're talking about paid or accrued, pay or incurred, there's an exception for unpaid expenses prior to funding. So if you had some outstanding rent that you were unable to pay, or outstanding obligations that followed under that non-payroll cost, you could pick those up, and that's the same with the payroll. So you could pick that up in the beginning by paying them in the period. Next slide, please. And finally, I'm just going to mention the double dipping on benefits. There's been a lot of discussion about this. It's not just a big of a surprise for those of us in the accounting world. We know we have 265 tells us we can't take expenses for items that relate to non or tax exempt income. And this applies even for some of your nonprofits out there that are have maybe some of these expenses that relate to BI type items or are taxable income items. The IRS has come out with a revenue notice. This was issued on April 30th, and it said, look, we're not going to, you have to match up these expenses if, this is a reduction of your expenses. So for instance, the big questions we have out now is you have incurred those expenses in 2019 and don't get the loan forgiveness. And now we've talked about kicking out this forgiveness process a lot further and well into 2021. What do you do? How do you treat those expenses? Well, matching would tell us that you need to reduce them by the amount that you expect to be forgiven. Well, we don't know what that number is until it happens. So we're waiting on guidance, but what will happen is potentially there's some opportunity if you're taking that 24-week period to kick some income, taxable income into 2021, and by having the loan forgiven then, if you may be electing the 8-week period to accelerate some of that to 2020, depending on what we know tax rates. So there's some planning there that will, and other planning considerations about the 8 to 24-week period that we will need to look at too, just in general. So that's one other thing. There's a bill right now in the House. It would take a legislative action to change this. So we'll see what happens there. Actually, I think the bill's in the Senate, but we'll see what happens there. And with that, I'm going to turn it over to Sarah to talk about the reduction. So once you've met the 60-40, you still have an opportunity to have some reductions of what's forgiven.
Thank you, Erica. Can everyone hear me?
We can hear you, Sarah.
All right. Wonderful. So hi, everyone. I am Sarah Cresci, a business and tax attorney at Henderson Franklin. Today, as Erica discussed, I will be talking about how loan forgiveness can be reduced. I'll turn it over to you, Nirupa.
Thanks, Sarah. What effect does a reduction in a borrower's number of FTE have on the loan forgiveness amount?
So before I begin, Nirupa, I would like to remind everyone that this information is fluid and it is subject to change as we continue to receive more guidance and direction from the SBA and Treasury Department. I also want to note when I mentioned covered period, as Erica defined, it does include alternative covered period. I'm just doing it to avoid any confusion. So when I say covered period, that includes alternative covered period if the borrower has chosen that. So in general, a reduction in full-time equivalent employees during the covered period reduces loan forgiveness amount by the same percentage as the percentage reduction in full-time equivalent employees. So first, the borrower must select a reference period. That reference period can be either February 15th, 2019 through June 30th, 2019. It can be January 1st, 2020 through February 29th, 2020. Or in the case of a seasonal employer, either of the two preceding methods or a consecutive 12-week period between May 1st, 2019 and September 15th of 2019. If the average full-time employees during the covered period is less than the reference period, the total eligible expenses available for forgiveness is reduced proportionately by the percentage reduction in full-time employees. So let's take an example. If a borrower had 10 full-time equivalent employees during the reference period, and this declined to 8 full-time employees during the covered period, the percentage of full-time equivalent employees would have declined by 20%, and thus only 80% otherwise eligible expenses are available for forgiveness. Next slide, please.
What exactly does full-time equivalent employee mean, Sarah?
So I will first note that the CARES Act didn't define what full-time equivalent employee meant, but the SBA in conjunction with the Treasury Department has defined what a full-time employee means for these rules, which is essentially an employee who works 40 hours or more on average each week. The hours of employees who work less than 40 hours are calculated as proportions of a single full-time employee equivalent and aggregated.
How should the borrower calculate its number of full-time equivalent employees?
So borrowers seeking forgiveness should document their average number of full-time equivalent employees during the covered period and their selected reference period. As Greg mentioned earlier, you can never have too much documentation. For purposes of this calculation, though, the borrower has to divide the average number of hours paid for each employee per week by 40, capping that at 1. So for example, an employee who was paid 42 hours per week during the covered period would be considered a full-time equivalent employee of 1. For employees who are paid less than 40 hours per week, the borrowers may choose to calculate the full-time equivalency in one of two ways. The first way is essentially you're going to take the number of hours that they worked under 40 and divide it by 40. So for example, if an employee was paid for 30 hours per week on average during the covered period, the employee would be considered a full-time equivalent employee of 0.75. If I divide 30 by 40, I would get 0.75. Similarly, if they work 10 hours a week, it'd be a 0.25 full-time equivalent employee. Second, the other method of calculating a full-time equivalent employee for a part-time employee, for administrative convenience, what the SBA and Treasury Department has done is that you can elect to treat every part-time employee as a 0.5 part-time employee. Now that could work to your advantage or disadvantage depending on how many part-time employees that you have. But it was really just to allow flexibility to borrowers in calculating the full-time equivalent employees. But note that once you select a method, that method you have to apply consistently to all part-time employees for the covered period and the selected reference period. Next slide, please.
What effect does a borrower's reduction in an employee's salary or wages have on the loan forgiveness amount?
So a reduction in employee salary or wages in excess of 25% will generally result in a reduction in the loan forgiveness amount unless an exception applies. Specifically, for each new employee in 2020 and each existing employee who is not paid more than an annualized equivalent of $100,000 in any pay period in 2019, the borrower must reduce the total forgiveness amount by the total dollar amount of the salary or wages reduction that are in excess of 25% of the base salary or wages between January 1st of 2020 and March 31st of 2020, which is considered the reference period, unless the reduced wages or salaries are restored by December 31st of 2020. Note, this was the extension that was granted through the recently enacted Act. Initially, it was June 30th of 2020, which has now been extended to December 31st of 2020. Now, just note one last thing, that this reduction calculation is performed on a per employee basis. It's not performed in the aggregate. Next slide, please.
If a borrower restores reductions made to employee salaries and wages or FTE employees by no later than December 31st of this year, can the borrower avoid a reduction in its loan forgiveness amount?
So yes, in both instances, the safe harbor would be met, and there would be no reduction in loan forgiveness as long as the borrower restored any salaries or wages or full-time employees, full-time equivalent employees by no later than December 31st of 2020. Next slide, please.
Will a borrower's loan forgiveness amount be reduced if that borrower laid off or reduced the hours of an employee, then offered to rehire that same employee for the same salary and same number of hours, or restore the reduction in hours, but the employee declines the offer?
So no, it will not. This is an exemption and it will not result in loan forgiveness. The exemption is also available if a borrower previously reduced the hours of an employee and offered to restore the employee's hour at the same hourly wages. But specifically when calculating the loan forgiveness amount, you may exclude any reduction in full-time equivalent employee headcount that is attributable to the individual employee if the following 5. First, the borrower made a good faith written offer to rehire the employee or restore the reduced hours of such employee during the covered period. Second, the offer was for the same salary or wages and the same number of hours as earned by the employee in the last pay period prior to the separation or reduction in hours. Third, the offer was actually rejected by the employee. Fourth, the borrower has maintained records documenting the offer and its rejection. And fifth, the borrower informed the applicable state unemployment insurance office of the employee's rejection of offer of reemployment within 30 days of the employee's rejection of the offer. As Greg mentioned earlier, documentation is key.
Are there any additional safe harbors available to borrowers if they're unable to rehire employees?
So the new recently enacted bill offers a new way out for borrowers essentially who lose full-time equivalent employees. The bill provides that during the period beginning on February 15th of 2020 and ending on December 31st of 2020, the amount of loan forgiveness will not be reduced when a borrower experiences a loss of full-time equivalent employees if the borrower in good faith is able to document any of the two following. First, there was an inability to rehire individuals who were employees of the eligible recipient on February 15th, and there was an inability to hire similarly qualified employees for unfilled positions on or before December 31st, 2020. Or second, there was an inability to return to the same level of business activity as such business was operating at or before February 15th due to compliance requirements or established guidance issued by, for example, the Secretary of Health and Human Services, the CDC, OSHA, during the period beginning March 21st, 2020, and ending December 31st of 2020. And that could be anything related to things like the maintenance of standards for sanitation, social distancing requirements, or any other worker or customer safety requirement that's related to the coronavirus. Next slide, please.
Will loan forgiveness be reduced if the employee was fired for cause, voluntarily resigned, or voluntarily asked for a reduction in hours?
No, it will not. So the reasoning behind this is because the SBA and Treasury Department doesn't want to penalize the borrowers for changes in employee headcount that are a result of an employee's actions or requests. But if this is the case, make sure you maintain records showing that the termination or that the employee requested this change. Lastly, I want to mention one last point that Erica briefly mentioned before she finished up her section, and that is another way a loan forgiveness could be reduced is that if a borrower spends less than 60% of the PPP loan on forgivable payroll costs during the covered period. As she mentioned, the loan forgiveness would be reduced proportionately, but she also stated that the joint statement was also unclear. So we are waiting further guidance, and we do expect additional guidance and clarification along with a modified loan forgiveness application. So as we've all stated before, this information is subject to change. We do expect more guidance. We do expect even the reduction in loan forgiveness to change. So stay tuned and, keep up to date with the PPP. And for now, that's it for me. And I'll turn it over to my colleague, Attorney Michael Leonard. Thank you, guys.
Sorry, I forgot to unmute myself. Good morning, everyone. Thank you, Sarah, Erica, Greg. That was very informative. Like Greg, I'm also honored to be on the panel. I know that I would love to leave time for questions, so I'll try to run through this quickly. It's the audit and appeals portion. You guys will all be fine. You'll get through it, especially with all the help from the collaboratory and everyone on this call and your lenders and CPAs and things like that. Kim, could you go to the next slide? Thank you. So the forgiveness process overview. You'll have your application, you'll do your calculations, you'll make sure you document where your money came from, try to avoid any appearance of commingling the PPP funds with your standard operating account, so you can make it easier for the reviewer, both the lender and the SBA, to ensure that it was the PPP funds that are spent for the designated purposes so that you can ensure you get forgiveness. Make sure you do your calculations for the FTE, like Sarah said, and the payroll and non-payroll expenses like Erica had talked about. And then the safe harbor and things like that too. Make sure you look at those. And then so once you submit the application and the required documentation, the lender has 60 days to make a decision. A key point there is the 60 days is contingent on giving the lender a complete application. So spend a little bit of time. I know it's probably a little stressful to put everything together and to make sure it's forgiven and you're not going to actually have to take a loan, but take a little bit of time to make sure your application is complete before you submit to the lender to minimize your turnaround time frame and maybe take a little stress off yourself. Regarding the lender's review, it's a good faith certification. Lender's obligated to make sure that you have all your certifications that you need to have the PPP loan, like your necessity certification, given economic uncertainty, which we'll talk about a little bit more in a second. But they're not reviewing your application in whole for the most part. It's just kind of a broad overview. Now, if you do use a third-party payroll provider, they even get the lender has a little bit more discretion to kind of look things over because the third-party payroll provider wants to do things correctly and doesn't have that, I guess, appearance of impropriety or bias that maybe you have when doing your own payroll calculations and things like that when you're applying for forgiveness. So the lender will look through it, make a good faith certification, and then if they see any material defects, then they have to go back to you for information and try to get you to fix that before you submit it to the SBA. Now, once the lender makes its decision in 60 days, the SBA or the lender, like I said, could ask for additional information, and then you could appeal the lender's decision within 30 days of the date the lender's decision comes out. There will be a new interim final rule coming out sometime. As of yesterday, I hadn't seen it come out yet, but there will be another final rule on appeals in the process there. And then from when the 60 days, the SBA, after the lender's decision, has 90 days to make a decision. Now that 90 days, if the SBA decides to review your loan, then that 90 days may get extended, or if you appeal it or things like that, those can cause that 90-day period to extend out. Next slide, please. So once you prepare your forgiveness application, I would start as early as possible. You'll have to get a lot of documentation together. Like Greg said, the forgiveness application is rather extensive. Maybe it'd be a good idea to get done as soon as you can. Make sure you have your entity documentation and your entity structure documentation so that you can show that you were in business prior to 215 to make sure that you were a qualified eligible entity for the PPP. Make sure that you don't violate the affiliation rules that were in place there, and just to otherwise show that you are eligible for forgiveness. Support for your necessity certification. Now, a lot of people had come up with questions and there was concern regarding the necessity certification because of those big companies that had taken it, and there was a lot of public outcry. So the SBA issued some guidance saying, you need to be able to support it, and we're going to audit you and do things like this. But then they came out with a later safe harbor saying if it was greater than $2 million in your PPP loan, then we will be auditing you, and you need to look at forecasts and demand and supply and what you think COVID's done to your market and your business. But under 2 million, they're giving you a free pass, at least on necessity certification. Now, that doesn't mean that they won't audit you for some other reason, but at least with respect to the necessity certification, you're okay. If you're over 2 million and they do audit you, the guidance seems to indicate that they will just request repayment and they won't seek civil and criminal penalties, or at least refer to other agencies that might do that. But that doesn't mean that the Attorney General's office or the DO or Department of Justice won't undertake their own actions to do something like that. So just be careful to support it. Make sure you also have your payroll reports for the periods and W-2s, evidence of your group health and retirement benefit payments. It's just making sure that you support where you spent all of your funds so you can get forgiveness. And then your evidence of your non-payroll agreements. And like Erica said, it got to be agreements in place before 215 for those mortgage interest, rent payments, and mortgage interest rate payments, and the other one. Sorry, I don't remember that now. Next slide, please. I'll remember in a second. So what about unforgiven funds? You have your 2-year maturity, which Greg alluded to earlier. It stays at a 2-year maturity for pre-June 5th payroll protection program loans. But since the Paycheck Protection Flexibility Act, and I'll call that the PPPFA for a little easier speaking, since that came out on June 5th, any loan after June 5th will be for 5-year maturity minimum and a 10-year maturity maximum, but the pre-June 5th loans, if the lender agrees, can be extended to a larger maturity date. The 1% interest will be for any unforgiven funds. It'd be a 6-month payment deferral. That was the before. Now it's the payment is deferred until your loan forgiveness is determined by the SBA. And then for any unforgiven funds, the funds must still be used for permissible purposes. And that means essentially you have to use them for forgiveness related purposes, but they get a little bit of an expansion there, and they allow them to be used for rent, utility, and mortgage payments. There you go, utility, the one I forgot before. So rent, utility, and mortgage payments that were in place after 2/15, you can use for your unforgiveness funds, but make sure that it's only interest on the mortgage payments. And then you can also use it for other debt obligations that aren't secured. So mortgage is a secured obligation. Ones that aren't secured, you can use it if those were in place before 2/15. You can use on those and only to the extent of the interest. Next slide, please. Will you be audited? I don't know, but maybe. The SBA has broad discretion to audit any loan. Like I said, necessity certification, they'll give you a safe harbor there, but it doesn't mean they won't look at it. If they do audit you, you will know. The SBA will notify your lender. Lender has 5 days to notify you. The scope of the audit is limited to eligibility, use of the funds, and the amount of the funds, and then forgiveness. So they'll look at all 4 of those different categories and see to make sure everything was used correctly. Now, the audit it's a big deal. I mean, you're spending there's a lot of public taxpayer dollars being distributed throughout the country to all kinds of different businesses, and both the public and the agencies want to make sure that taxpayer dollars are spent correctly. So they'll be looking at a lot of these loans. Required to keep your PPP records for 6 years from the date of forgiveness or repayment in full. Just make sure you keep your records on file in case the SBA wants to come back and ask questions. If you're found ineligible, it could be a big deal. The lenders made the loans under the impression that the SBA would be guaranteeing all of the loan funds, and if you're an ineligible entity, that guarantee is revoked. The lender may hold you in default or demand payment or things like that. And then it's your eligibility for the PPP. If you're found ineligible, it undermines the non-recourse provision of the CARES Act. So the CARES Act said borrowers won't be held responsible for the PPP loans, but that was only eligible recipients. So make sure you're eligible and document that when you submit it to your lender in an application. Next slide, please. And the PPPFA. I will just go over this real quickly. I want to leave time for questions, and I know we're running short here. So like everybody said, there's a 60-40 payroll rule, and it won't be a cliff, or at least that's what they've indicated on agency-wide. The cover period, like Erica said, extends 24 weeks, or you can choose the 8 weeks or the later, or everything ends at December 31st, 2020. Extended maturity date, like I said, maybe 2 years if you're before June 5th, unless your lender agrees otherwise, or 5 years after that. And then the PPP now permits recipients to take advantage of the payroll tax deferral. That was a new thing. Before, they were mutually exclusive options. And then expand your forgiveness safe harbor, kind of along the same lines that Sarah talked about. And without further ado, I want to thank the Collaboratory for putting this on. I think it's awesome. I think the panelists, like I said, have been honored and very informative. I'm happy to turn it over to Nirupa and Tricia for questions.
Thanks, Michael. And we think all of you panelists are pretty darn awesome as well. I'm now going to turn it over to Tricia. Tricia is going to be looking at the questions in the Q&A. Feel free to also raise your hands.
Awesome. All right. Well, that was a lot of information. I don't know about you, but I definitely feel a little bit smarter today. So that's great. There's a lot of questions in here, some that I think that were answered, but I do think if we could just maybe get like just a quick synopsis from those on the panel to just maybe kind of summarize. But I'm just going to go through them. Michelle had asked a question on the 100K payroll cap, annual or just amount during forgiveness period. Do any of the panelists want to answer that?
Oh, I will. Annual. It's an annual payroll cap.
Perfect. How do we handle the 10K from EIDL with the PPP?
I'll take this one. So the $10,000 that is in the question, I'm assuming it is related to the economic injury disaster loan advance. So that has changed since it was first released. This is in relation to the acronym is EIDL, EIDL. And it is a loan, a disaster loan program. These disaster loan programs have been in place for some time. But in applying for that loan, you had the option to check a box and receive within 3 days a $10,000 non-recourse advance. And then that $10,000 changed to $1,000 per employee up to $10,000. And the funding for those advances and for that program ran out quicker than the PPP funds did in round one. And so many of you, a high percentage of you probably applied for that loan, definitely checked that box for the advance, applied for the PPP loan, and got your funding for the PPP, and then miraculously, maybe a few weeks later, you saw $1,000 up to $10,000 be deposited into your check from the Treasury. That advance amount is a grant. And so what the SBA and the Treasury have provided in guidance is they will deduct whatever amount you received in the form of that advance, again, up to $10,000, from your forgiveness amount that you remit to your lender. So if you had received that advance amount, it's important that the SBA, not the lender, they will, when they receive the request for forgiveness, they'll deduct that EIDL advance amount from your forgiveness amount, meaning it will still be remaining on your loan. So if you do have funding left available in your loan, your PPP loan, perhaps hold that back. And so you have that available to repay once you have your forgiveness approved. Now, the EIDL loan itself, we do have a number of our borrowers and customers who actually did receive an EIDL loan as well. And what's very important is that loan you could use on a multitude of business expenses, including payroll. It is very important that you do not utilize the funding from your EIDL loan, not the advance, the loan, and your PPP loan. You cannot utilize those funds on the same expenses. If you do, your complete EIDL loan needs to be refinanced by your PPP loan. So there's a lot of information there, but just some quick pointers and things to know if you have received an EIDL advance or an EIDL loan.
Great, thank you, Greg. Do you have to rehire the same person, or can we rehire another person in the same job? What was the 3 different look back periods? Do we get to pick?
I think you can rehire different people. Your 3 look back periods are February 15th to June 30th of 2019, January 1st, 2020 to February 20, I think it's 29th, it's a leap year, 2020. And then
it is 29th, you're right.
12-week period between May 1st and September 30th of 2019.
May 1st and September 15th.
September 15th. Okay, there you go.
You're close. You did well.
Everyone's shaking their heads at the same time, so I feel like that's a good measure of that we're on. Yeah. Another question, this comes from James. Thank you, by the way, Michael. I have rehired laid off employees to meet the head count rule. After I apply for forgiveness, how long do I have to maintain that head count to stay in compliance?
I think you only need to maintain it until your forgiveness application is approved. Or at least, I don't even know if you need to wait till it's approved. I think you can just wait until you've submitted it, and that's your date.
Great. The other question from James is, my corporate fiscal year occurred in the middle of the PPP period. Excuse me. We are waiting for federal guidance. Do you have any advice on what will be deductible or not for completing tax returns without confirmed information direction from the SBA or Treasury?
I'll go ahead and take that one. I would say extend if you can, because we should be hopefully receiving some guidance soon. The issue that you want to avoid is, I mean, you can obviously amend if something comes up and changes things. For right now, the rule is it's non-deductible. So if you've received your confirmation that of forgiveness during the period in which your reporting period is, if you've got a loan forgiveness, then you would report that reduction against those expenses. Now, if you have an application in process and it hasn't been forgiven yet, then you don't have the forgiveness yet. So you don't know whether or not it's going to be forgiven. At that point, you record those expenses as normal. If you get the forgiveness in the following period, then you would include that as a reduction in expenses for that period. So you can see it could straddle 2 periods here. And we could get a bill that goes through that says, hey, this is going to be tax, there's no reduction. Then at that point, if you've already filed, then you would have to go back to amend. Taken it. If you haven't included it, if you haven't done the forgiveness yet, then you wouldn't be including it in the following period at that point. So the point is unless you've received the funds during that fiscal year period, receive the forgiveness, then you wouldn't be reporting anything anyway.
Thank you, Erica. I also just wanted to note that I think we are going to run over, but I would like to continue the Q&A if possible. So if you need to jump off, go ahead. There will be a recording of this. We will send out all the materials. If the panelists can still stay, that would be great if you also have to jump off, but I would like to continue just finishing through these if possible. So I appreciate everybody.
Tricia,
Next question.
As a point of clarification, for the keeping your employee on, how long do you need to keep them on? You would just need to keep them on through the covered period. If you're either 8-week or 24-week selection, that's your period for your FTE calculation. So as long as you keep them on through the end of your covered period, you should be fine.
Thank you. That's a good clarification. From Bob, can I elect the 75-25 8-week calculation?
What we understand, the SBA and Treasury, although they haven't released the interim final rule yet specifically to these changes, they did release a joint statement that just kind of outlined what's coming. And in that, if you have a PPP loan prior to June 5th, you can elect to choose and stay with the 8-week period or elect to go with the 24-week period. And what does that mean if you select or do either or? There isn't a definitive answer. All right, if I select the 8-week period and I just stay with that, am I still under the 75-25 or am I now under the 60-40? That official guidance hasn't come out yet, but the 8-week versus the 24-week, what we do understand is that will be a choice if you have a loan prior to June 5th. And that guidance, again, we're hoping is going to be coming out any day now, hopefully before the weekend.
Great. On the same payroll question, if you spend, biweekly payroll, can you use cash on front end and accrual on back end, or must it be cash, cash, or accrual, sorry.
I'll try to take that one for you. Yeah, it would be cash on the front end and accrual on the back end. So basically, if you've got, any periods that, and it doesn't matter what your period is, the biweekly portion is to say that if you can elect to say if your pay period started, if you got your funding on the 6th, but your pay period, your pay dates, pay period starts on the 10th, you can elect that 10th as your beginning and then carry that through the 8-week or the 24-week period. So that's when your covered period starts as far as the difference between biweekly and the larger amount. Now, as far as if you had maybe 4 weeks of pay that you hadn't done yet because you were, didn't have the ability to, there was cash flow issues, you could pay that all up in that beginning, at the beginning of your covered period once you've got the funding and make all that up. On the back end, if you still have, say your period ends on the 25th of a month and you still have 5 days in that period, you can, the pay date happens after that, you can take those, that period and put that into an accrue for that period that you haven't paid yet. So up to the point of the final date. So you can accrue at the end and have it unpaid and pay it within the next normal cycle. And you can front load with the cash at the beginning if you have some unpaid payroll. Let's see if that makes sense.
All right, so I have kind of a double question again, talking about payroll. If you spend 80% during the 24-week period on payroll, can you count all 80% and only 20% on other costs? And then Mary says, building on that question, can you spend 100% on payroll and 0% on non-payroll and to reduce the supporting documentation?
Yeah, I think,
I'll,
yeah, you can go ahead.
no, go ahead. Okay, so if you, so the 75, 25, 40, the 75 that is now changing to 60, those were set as a minimum. So at a minimum, you had to expend those percentages on payroll expenses, eligible payroll expenses. You know, as this was coming out and as we've talked about, you know, from the very beginning, and we've said over and over again, this is fluid, subject to change because it has changed so much. You know, one of the safest things to guide borrowers and our customers is use as much of this on payroll as possible, because we don't have definitive guidance on what does transportation cost mean. Is it just mileage? Is it gas? Is it what's encompassed that? What is the utility expense? So you can absolutely use 100% of your loan proceeds on payroll. If you use 80%, 70%, anything above those thresholds that now moving forward is 60% and previously was 75%.
All right, so we're going to keep moving. Is severance pay for employees who resign included as wages for forgiveness purposes?
I haven't read any specific language in any of the IFRs regarding payroll costs. As you know, if you do if an employee decides to leave in severance, I haven't read any specific guidance if severance is an eligible payroll cost.
Perfect. All right, back to those other questions that came up besides payroll. Is garbage collection, waste management an approved utility?
Again, we have very limited guidance on utility side. And as Greg mentioned, your best bet, you have 26 weeks now. When this was the 8-week period, everyone was getting creative with, you know, utilities and trying to figure out what would be defined as transportation. Now, it doesn't matter as much. We have 26 weeks. You know, you have other opportunities to meet it through that period. You're looking at 9.5 weeks that you have to, of payroll costs that you have to forgive over a 26-week period. So I would say use as much of it for payroll, and some of these other ones, if you're not sure about it and we don't have additional guidance, it's probably best not to be.
Great, thank you, Erica. Mary asks, is there a cap on employee benefits, specifically if there is a retirement plan match? Is it capped at the employer percent match? Excuse me. Is it capped at the employer percent match times 100,000?
I think it's based on your 2019, what you've done the same period in 2019. I think that would be your cap. You can't just arbitrarily like allocate a bunch of retirement benefits or matches this year to try to use up the PPP funds. They're going to look back at 2019s to make sure that it's in line with that.
All right, so another kind of question about the utilities and transportation. Under transportation, does that include bus vouchers or toll fees paid for or on behalf of the employees?
Again, we don't really have much guidance on transportation, so I would say that if it's not really related to a utility, to try to avoid those costs as much as possible if you can meet it otherwise until we get further guidance. We may not get much guidance there because they expanded the period.
There was a word said transponders, question mark. I'm assuming there's a question of what that definition is. Allison, you may have to expand if I don't know what that means. I'm sorry.
Well, now I keep hearing I'm going to use all my money on payroll, but I think originally I was thinking are transponders part of transportation? You know, tolls.
Going back. Mm-hmm.
All right. Yeah, some
But
of
no
these
worries,
questions,
Greg. I'm using all my money on payroll.
yeah, some of these questions were in the middle, so we are kind of taking them in and out. What about, Jen asked, what about new equipment for the business, which was going to be purchased prior to February 15th, but the purchase was postponed? Are we able to purchase the equipment now?
It is, so all of the eligible non-payroll expenses, such as business mortgage expense, utilities, and everything that we talked about, they had to be in place, active prior to February 15th, 2020. So if you had a lease in place, you've been paying rent prior to February 15th, you've had that mortgage prior to February 15th. The key is those had to be in place and active prior to February 15th of this year.
To build on that, if you're not looking for forgiveness, you could use it for interest payments if you're securing that personal property. If you're securing that equipment with some kind of security agreement, you could pay interest on that if it's in place after February 15th, but you wouldn't be able to get forgiven for those expenses.
Perfect. And there's just been a few questions that have come in after I started this. Mary asks, is there a cap on employee benefits? Oh, nope, I guessed that one, excuse me. Can you distribute any unused PPP money as bonuses to staff?
The bonus, as long as it's within that pay, the 46,153 cap for the period over the 24 weeks, then you could give bonuses as part of your compensation. It's just you're going to be capped at that $100,000 limit, which then if you're using the 8 weeks, it's going to be the 15,153. If you're using the 24-week period, then that's, annualized to the 46,153. So you would be capped at that compensation cap.
And the last question, I think, and if I missed any, I apologize, is the FTE calculation for the average of the entire period, 8 weeks or 24 weeks?
All right, I can take that one. I believe that was asked by Bob. Bob, it's whatever covered period that you choose. So if you choose the 8-week covered period, that's fine. If you choose a 24 covered period, that's fine too also. Or if you choose the alternative covered period, it depends on which covered period you choose.
Yeah. The question is when you're calculating the FTEs, can you just take let's say the 8-week period, can you just take the total hours for the 8 weeks and divide it appropriately, or do you have to take each week separately, or just the last week, or how do you do that?
There's a wonderful schedule, Schedule A, that's part of the 3508 form, which has where you have to actually list out all these details by the weeks and everything. So it can be a lot of calculations there. And what Greg mentioned in the beginning is to talk about streamlining, which he may want to jump in here and say a little bit there, but we're hoping that the new application has some easier things.
Yeah. And an important note is in that news release that the Treasury and the SBA released on Monday, they said that a modified borrower application form. So if you have not gotten a PPP loan or applied for one yet, there's going to be a new application, a modified application for that. And then this, I think, affects most everyone on this webinar. They are modifying the forgiveness application. We hope to speak to a lot of the questions that we have here. Hopefully the calculations maybe get a little more streamlined. There's been a tremendous push from a variety of business industries, banking industries, to our legislators, to the SBA and Treasury to streamline this application process. It was a lot easier to get the funding and apply for that, and all of the calculations required now to get the forgiveness. There's even a big push, and there has been some progress, and we don't know where it will go, but there has been a big push to just do a blanket forgiveness on loans under a certain threshold. And there's been discussion of if you have a loan of $350,000 or less or $150,000 or less, those are the two numbers we've heard, that it's a blanket forgiveness. You certify and attest to the fact that you did use these funds correctly. You provide your documentation. and is done, but that is not in place. We don't know if it will go in place, but that's a lot of the things that are happening up in Washington right now.
So before
I'll just
go,
add on to that.
Go ahead.
No, go ahead, Tricia. Bob, did I answer your question? Erica and Greg, thanks for jumping in. I somehow got stuck on mute on my phone. Did I answer your question, Bob? The schedule currently right now, as Erica mentioned, is very intrusive. It's very elaborative, and you really have to go one by one. But as Greg had mentioned and Erica alluded to, you know, we're hoping for a very streamlined application.
Perfect. And I'm just going to end with there was obviously a lot of questions. If I missed any, just keep in mind we will be, this is a recording. We're going to send this out. There's also a survey. I know Narupa is going to mention it, but I'll just give the plug now. The survey actually has, if there's an outstanding question you have in there, but please take it. It's the way we learn about these programs, and it's how we get better on them. But I also just want to thank the panelists. That was amazing. I know I can tell you from what I understand from hearing from nonprofits in the community, this was needed. People really needed to hear a little bit more about what was going on with PPP. So we do appreciate you. And to everybody who participated, we appreciate you and the change makers on here. But I'll turn it over to Narupa, and thank you, thank you, thank you.
Tricia, I also want to thank our amazing speakers for sharing their expertise with us today. And we want to thank all the participants. We hope you all found this webinar useful. If you'll please complete the survey in the chat box, we would really appreciate it. Again, we will be sharing the recording and slides with all of you. I hope each of you has a great week, and thank you for joining us.
Thank you for
Bye.
Thank you.
Thank you, everyone.